Good afternoon, everybody. Today is the first session for block 3 of accounting for managers, and the topic is cost, volume, and profit analysis. Cost means the amount of expenditure, actual or notional, incurred or attributable for a given thing. So there are four components involved in it, four types of cost. One is the actual cost. That means the cost which has been or the expenses which has been incurred for production of the product commodity, and the notional cost. The second component is the notional cost. Notional cost means where the expenses are incurred but it doesn't result into outflow of cash, like your depreciation, amortization, depletion, etc. That is the second component of cost. And the third component of cost, third and fourth, is incurred and attributable. Incurred means what has been spent for the purpose, and attributable means which has to be allocated for the purpose of the production of any product. But it is not, it is in it, the third one is incurred and the fourth one is the attributable. So the combination of all the four components, that is actual, notional, incurred, and attributable, is called the cost of a product. There is another similar type of nomenclature used, which very often creates confusion, that cost and price of a product. Cost, price, and value. Although all the three terms appears to be one and the same, but they vary from each other so far as the cost accounting concepts are concerned. Price means the amount of money paid or payable for a given thing or for enjoying of any services. The amount of money paid or payable for buying of any commodity or for enjoying of any services is the price. Suppose a person is pursuing MBA program by paying 5 lakhs rupees for a couple of years. If the 5 lakhs rupees is paid entirely at the time of admission, the price for the MBA program will remain same to be 5 lakhs. If it is paid in two installments or four installments on semester wise, whatever it may be, still then the price for the MBA program will remain at same 5 lakhs. It doesn't matter whether the money is paid at a time in advance or it is paid in installments, in various installments, still then the price will remain same to be 5 lakhs. It is about price. The third component which appears to be similar with that of cost and price, that is called value. Value are of two types. One is value in use and the value in exchange. The value in exchange is exactly similar with that of the price. Suppose we are paying 5 rupees for buying of an use and throw plane, which is for our own use. That means the price, that is the value in use. We are paying 5 rupees and buying a pen which is required for our purpose. That is value in exchange. But the value in use is something different from that of the value. Value in use is something different and important from that of the value in exchange. Value in use is has been nicely explained by Adam Smith in the Paradox of Value, in its books, The Paradox of Value. In order to explain the value in use, he has given the example of mother's milk for a newborn baby. Can it be evaluated? Just not possible. He has also given another example, a glass of drinking water for a very thirsty person in a desert. It just cannot be evaluated. So it depends upon the value in use, depends upon the degrees of utility, the degrees of urgency, and the degrees of necessity of the situation or the product purchases at the time of its requirement. That is the value in use. So this cost, price, and value, although the three terms appears to be similar to each other, but they are not similar to each other. They varied in a very different manner. So this is cost. Then cost, volume, and profit. Volume means the volume of the production, the quantity of goods manufactured or produced in any organization or in any entity or in any unit. That is the volume of production. Cost, volume, and profit analysis is a part of the marginal costing. Marginal costing means, if we'll refer to the slides, it creates a differentiation between the marginal costing or the variable cost and the fixed cost. The, the costs are classified in different manners. One, the first classification is on the basis of nature. When the cost is classified on the basis of nature, there are three types of cost. One is material cost, another is labor cost, another is the expenses cost. The cost can also be classified on the basis of activities. When the costs are classified on the basis of activities, it may be of three types. One is the production cost, another may be the administrative cost, and the third one may be the selling and distribution cost. And the cost can also be classified on the basis of behavior. When the cost is classified on the basis of behavior, it gives rise to three types of important types of cost. One is the variable cost, another is the fixed cost. Variable cost is that cost which varies directly and proportionately with the volume of production. That means when you are producing 1 unit, if the variable cost for 1 unit is 10 rupees, and if you are producing 100 units, then exactly it will vary, exactly it will be the multiplication of the 100 for the 100 units. That is called variable cost. It varies directly and proportionately with the volume of production. That is called the marginal cost or the variable cost. In other words, the fixed cost means the cost which remain constant irrespective of volume of production for a certain time frame and for a reasonable range of production. That means it doesn't vary with the volume of production and it remains constant. And this marginal costing, the topic marginal costing, the application part of which is the cost, volume, and profit analysis, is a method of costing, or it is a technique which is concerned with the changes in cost and profits resulting from changes in the volume of output because of variable cost. It is otherwise known as the variable costing. The variable costing and the marginal costing is one and the same. Only the variable costs are regarded as the cost of product, while the fixed costs are treated as the period cost which will be incurred during the period regardless of the volume of output. The fixed cost doesn't vary with the volume of output. It will remain constant for a certain period and for a certain range of production. The characteristics of marginal costing is, the first characteristic is, it helps management in taking many managerial decisions, and it is not independent system of costing such as process costing or job costing. In case of process costing and job costing, what happens? There is particular method of costing. They are having a particular process under which the cost of production is being determined. But this marginal costing is not a system. It is not a system of costing or a method of costing. This is it is a system which helps the management for taking several managerial decisions. In a later stage, we will discuss in what way the marginal costing is helpful for decision making in the hands of for managerial decision making or for decision making in the hands of the management. The second characteristic of marginal costing is all elements of cost, that is production cost or factory cost, administrative, selling, and distribution cost, are classified into variable cost and fixed cost separately and distinctly. Besides this variable cost and fixed cost, there is another type of cost which is called the semi-variable cost. But in case of marginal costing, the concept of semi-variable cost is not at all considered. It is either segregated, which is more in the nature of variable, it will be taken under variable cost. If it is more in the nature of fixed cost, it will be taken into the fixed cost. So the semi-variable cost has no significance so far as the marginal costing is concerned. It is only classified as variable cost or fixed cost. The variable cost or the marginal costs are regarded as the cost of the product. The cost of the product means the variable cost. And the fixed costs are treated as the period cost and are charged to profit and loss account for the period for which they are incurred. It may be for a month, it may be for a period, it may be for a quarter, it may be for a half year, it may be for a year. So accordingly, it will be debited to the profit and loss account of the organization for determination of the profit and loss of the organization. It has nothing to do with the cost of the product. The fifth characteristics of marginal costing is the stocks of finished goods and work in progress are valued at marginal cost only. I'm reiterating, the stocks of the finished goods and work in progress means the semi-finished goods, semi-finished stocks, which are in the process of production, which has not yet completed, it has not attained its final set. Both of them are valued at the marginal cost only, or only the variable cost is taken into consideration for their valuation. The sixth characteristics of marginal costing is prices are determined on the basis of marginal cost by adding contribution. By adding contribution which is in excess of sales or selling price over marginal cost of sales. This is the last characteristics of marginal costing, under which the prices are determined on the basis of marginal cost by adding contribution. Contribution means the sales minus variable cost. By deducting the variable cost from the sales, we will determine the contribution. Contribution is the excess of sales or selling price over the marginal cost of sales. So these are the 6 important characteristics of marginal costing. Then assumptions of marginal costing. When we go to discuss about the marginal costing in detail, we need to take certain assumptions into consideration on the basis of which the system is based. The first assumption of marginal costing is all elements of cost, production or factory cost, administration or selling and distribution cost are segregated into 2 segments. One is the variable, another is the fixed cost or variable cost. From the very beginning, we made a discussion that when the costs are classified on the basis of activity, there are 3 ways of making classification. One is on the basis of nature, one is on the basis of activity, third one is on the basis of behavior. When the costs are classified on the basis of activities, there are 3 types of costs, which is called the overheads. One is the production or the factory overhead. The second one is the administration overhead. And the third one is the selling and distribution overhead. These are the elements of cost on the basis of which the cost sheet is being prepared. So when the 3 types of cost classified on the basis of activities are taken into consideration, they are also segmented on the basis of the behavioral cost, that is fixed cost, and variable cost. That is the very first assumption on the marginal costing. The second assumption is variable costs remain constant per unit of output irrespective of the level of output and thus fluctuates directly and proportionately in changes in the volume of output. Variable cost directly and proportionately varies with the volume of production. That is the essentiality of the marginal costing. That is the second assumption. The third assumption is the selling price per unit remains unaltered or unchanged, or it remains constant at all levels of activity. Whether the volume of production is 100, whether the volume of production is 1000, whether the volume of production is 10,000, or the volume of production is 1 lakh, the selling price per unit or the per unit selling price will remain unchanged. It will remain constant. That is another assumption of marginal costing, Otherwise, it will not work out properly. That is the third important assumption. The fourth important assumption under marginal costing is the fixed costs remain unchanged or constant for the entire volume of production. When you are assuming that the range of production is such, during that particular range of production, the fixed cost or the amount of fixed cost will remain unchanged and constant. Per unit fixed cost will definitely vary depending upon the volume of production, but the fixed cost in entirety or in the totality over the period will remain constant and it will never change over the volume of production. The fourth, the fifth important assumption under marginal costing is the volume of production or output is the only factor which influences the cost. The volume of production or output is the only factor which influences the cost. That means when we are determining the contribution, which is the resultant of the sales minus variable cost, that is the most influential item in the entire system of marginal costing. Why it is called contribution? Contribution means the equation for determination of the contribution is sales minus variable cost, or the marginal cost is the contribution. Why it is called contribution? The nomenclature of contribution is the contribution contributes towards recovery of the fixed cost of the organization. That means the more the contribution per unit, the fixed cost of the organization will be recovered in a more easier manner. When it is ascribable for the recovery of the fixed cost, or it contributes towards the recovery of the fixed cost, that's why the nomenclature is the contribution. Contribution means, if you can see this slide, you will find out that it is difference between the sales and variable cost. That means the equation for contribution, C is equal to S minus VC, sales minus variable cost, is the contribution. It may also be defined as the excess of selling price over variable cost per unit. If the variable cost per, the example is, if the selling price of a product is 20 per unit and its variable cost is 15 per unit, the contribution per unit will be 20, the selling price, minus the variable cost 15, it would be rupees 5. So contribution, sales minus variable cost or marginal cost. In other words, you can say the contribution per unit is the selling price minus the variable cost per unit. That is the equation of contribution. When you look to the advantages of contribution, the first advantage in respect of contribution is, contribution means the sales minus variable cost. It helps the management in the fixation of selling price. That means when the market is a buyer's dominating when the market is a buyer's dominating market, fixation of selling price is a key factor for very sustenance or the existence of the product in the market. So it plays a very, fixation of selling price plays a very vital role in the hands of the management. So when we are able to determine that what is the volume of contribution in our hand in respect of a particular product, and its fixed cost is well ascertainable in our hand, then accordingly we can determine that what should be the selling price in our hand. So accordingly we can determine the margin of profit and our safe existence in the market about the continuance of the product in the market. This is the first advantage in respect of contribution. The second advantage in respect of contribution is it assists in determining the break-even point. If we look to the break-even point, the determination of break-even point, if the total fixed cost is divided by the contribution per unit, that would be the volume of production at which there won't be any profit, there won't be any loss. That means the total of revenue would be exactly equal to the total of expenses or the total of cost. Break-even point is that point where there is no profit or no loss. So how it is determined? The break-even point is determined by dividing the fixed cost by contribution or sales minus variable cost. because the contribution contributes to a recovery of the fixed cost. When the entire fixed cost is divided by the contribution, then the break-even point or the output at break-even point can be well ascertained. So that is the second advantage of contribution. The third advantage in respect of contribution is it helps the management in selection of a suitable product mix. Suitable product mix, suppose there are different products, product A, product B, and product C. Either product A and B are to be used, are to be continued, and C is to be dropped, or A and C are to be continued, B is to be dropped, or B and C are to be continued, A is to be dropped. So different permutation and combination is possible for maximizing the profit in the hands of the entity or in the hands of the organization. So in that regard, contribution helps a lot to the management in selection of a suitable product mix. The product mix which gives the highest contribution can be continued, and the lowest contribution, the product mix which gives the lowest contribution to the organization, that may be dropped. So the third advantage of contribution is it helps the management in selection of suitable product mix. The next advantage in the hands of the management is it helps in choosing from the alternative methods of production the method which gives highest contribution for limiting factor is adopted. When there are different choices left in the hands of the management as regards the method of production, so each and every method has to be tried, and the method which gives the highest contribution, obviously that method would be the profitable method for the organization, and that method has to be chosen, or that method has to be chosen to be continued in the organization, and the other methods of production or other alternatives available in the hands of the organization for production need to be dropped or deferred. So that is the fourth advantage of contribution for the management. The fifth advantage is it helps the management in deciding whether to purchase or manufacture a product. Suppose there is a main product of the organization and there are certain auxiliary products. Main product will obviously be produced in the organization. So take the example of a TV. When there is a TV manufacturing unit, when the TV is being produced, we can consider whether to produce its cabinet by its own organization, or we can buy the cabinet from the other organization, from the outside firms. In that case, the production also helps a lot for taking a decision whether we will purchase the cabinet, whether the organization manufacturing the TV will purchase the cabinet from the outside firms as per its specification, or it will produce the cabinet in its own organization. If by producing the product in our own unit, our contribution is lesser than that of the contribution of the others, then obviously we will go for the manufacturing of the cabinet in our own organization. Otherwise, it won't be beneficial to take a decision like this. So the fifth advantage is it helps the management in deciding whether to purchase or to manufacture a product. The sixth and the last advantage of the contribution is it helps in taking decision as regards adding a new product in the market. When there is opportunity of adding new products in the market, or to take a selection whether new products will be launched or an existing product has to be dropped from the market because of its lower profit, etc., then the contribution helps a lot for taking a decision like this. When there is a comparison of products, suppose there are two products A and B. Product A gives higher contribution and product B gives lower contribution. In that case, and the fixed cost for both A and B is same. So in that case, the product which gives higher contribution is obviously to be accepted and to be continued, and the other product has to be production of other product has to be dropped. Similarly, when a new product has to be implemented or to be launched in the market, we need to decide that how much or what is the contribution per unit of that particular product which we are deciding or which we are thinking of launching in the market in the near future. So it gives, if it gives the higher contribution, then obviously we can take a decision in its favor so that the product will be launched, and the launching of the product will be beneficial to the organization. The equation of contribution is equal to the sales minus variable cost or the marginal cost. Marginal cost and the variable cost is one and the same as defined, that the which varies directly and proportionately with the volume of production. Sales can also be determined as variable cost plus contribution, just changing over of the equation. Then sales can also be determined as variable cost plus fixed cost plus minus profit. If there is profit, it has to be added. If there is a loss, it has to be deducted. That is the another equation of contribution. Then variable cost, sales minus variable cost is also equated with, or is exactly equal with, the fixed cost plus minus profit. So these are the equations about the contribution. The next is graphical presentation of the variable cost. Essentially, there are two types of cost. One is the variable cost and the second one is the fixed cost. The variable cost, which vary directly and proportionately with the volume of production or sales, and the examples are hourly wages, utility costs, raw materials, etc. And labor cost also, direct labor, etc. The fixed cost is which are constant over a relevant range of sales and for a certain period of time. That is called fixed cost. The examples of fixed cost are executive salary, factory rent, lease payments, depreciation, etc., etc. If they are represented in a graph, we are measuring the unit of sales in the x-axis and cost in the y-axis. The variable cost will give an upward trend because when the unit of sales increases, the variable cost will automatically increase. When one unit is produced, it is, if it is one, then if it is produced, if we are producing second unit, then it would be two. If we are producing third unit, it would be three. We are producing fourth unit, it would be four. Accordingly, it will go up and down. That's why it is always a rising trend. The line is completely visible. That is rising. It is in a rising trend. And in the other graph, when where the fixed cost line is established, it is just parallel to the x-axis because the cost remain constant. The volume of cost or the totality of the cost is exactly same irrespective of the volume of production. When you are producing one unit, the total fixed cost remains same. When you are producing 100 units, the total fixed cost remains same. If you are producing 10,000 units, till then the total production will remain same. If you are producing even 1 lakh unit, the total production, the total fixed cost will remain same. That's why it is just parallel to that of the x-axis. So this is about the differentiation about types of costing on the basis of behavioral analysis, that is fixed cost and variable cost. Then come to the PV ratio, or the PV ratio is otherwise called the profit volume ratio, or it is otherwise called the sales and contribution ratio. Contribution to sales ratio, it is also called the marginal ratio. The profit volume ratio or contribution to sales ratio or marginal ratio is the relation of contribution to sales, and the equation of PV ratio is equal to contribution divided by sales. Since contribution is equal to sales minus variable cost or fixed cost plus profit, then the PV ratio can also be expressed as contribution divided by sales is equal to sales minus variable cost by sales. In other words, fixed cost plus profit, the whole divided by sales, is also PV ratio. Again, changes in profit or contribution, the change, the difference of profit or contribution divided by change in sales can also be interpreted as PV ratio, profit volume ratio. Suppose the sales is 1 lakh and the profit is 10,000 and the variable cost is 70%. That means to find out the PV ratio, the first we need to find out the PV ratio, then we need to find out the fixed cost, then you need to find out the sales volume to earn a profit of rupees 40,000. That means what would be the volume of sale for a desired amount of profit of rupees 40,000 in the hands of the organization. If this is the numerical presented before us, we need to calculate how it is to be determined. The variable cost is 70%. Sales is equal to 1 lakh. The variable cost is 70% of sales means 70,000. The total sales as given in the question is 1 lakh means, and the variable cost is given to be 70% of the total sales is, it comes to 70,000. So the first question to be answered is PV ratio. What is the PV ratio? Contribution to sales or contribution divided by sales is the PV ratio, or sales minus variable cost is the contribution. That sales minus variable cost whole divided by sales would be the PV ratio. So here sales is equal to 1 lakh and the variable cost is 70,000, being the 70% of the total sales, and this has to be divided by sales. Sales is again 1 lakh. So 30,000 divided by 1 lakh. So 1 lakh minus 70,000, it comes to 30,000. When 30,000 is divided by 1 lakh, it comes to 30%. So the PV ratio is 30%. That is profit volume ratio. So what is that profit volume ratio? Profit volume ratio or contribution to sales ratio, which is being calculated by contribution divided by sales, or fixed cost plus profit divided by sales, or sales minus variable cost whole divided by sales, is called the PV ratio. Higher the PV ratio, more will be the profit, and lower the PV ratio, lesser will be the profit in the hands of the organization. So when the PV ratio is high, then we can definitely say that the organizations is in a very the production activity of that particular product of that particular organization is in a very sound position. So higher the PV ratio, higher is the favorability for purpose of the production of the or particular product. The second one is contribution. Fixed cost plus profit is equal to sales minus variable cost or fixed cost plus profit. 30,000 is the contribution here. So fixed cost plus 10,000 is the profit. So fixed cost is equal to 30,000 minus 10,000, that is 20,000. Profit is given in the question. The profit is given, if you refer to the earlier here, the profit is given to be 10,000, sales is given to be 1 lakh, the variable cost is given to be 7,000. So here, for determination of the fixed cost, we can deduct, we can put the equation contribution is equal to fixed cost plus profit. So we are having the figure of profit in our hand, we are having the contribution determined in the first stage. So for determination of the fixed cost, we can find out the equation to be 30,000 minus 10,000. So 20,000 became the contribution. So third element of discussion in respect of the question given, you need to determine the PV ratio. PV ratio is equal to fixed cost plus profit divided by sales. Here we are having the fixed cost, which is coming to 20,000, and we are having profit, we are having sales. So 20,000 plus 40,000, sales, fixed cost plus profit. Fixed cost is coming to be 20,000, and 40,000 is the profit. Whole divided by the desired amount of profit is 40,000 as given in the question. When both the items are divided by sales, the sales is that would be the that is coming to 30%. That means 60,000 divided by sales. Sales is equal to 60,000 into 100 divided by 30. It is coming to 2 lakhs. That means when the amount of sales is 2 lakhs, then at that juncture, the organization is able to earn a desired amount of profit of 40,000. When the organization is able to earn a profit of, in order to earn a profit of rupees 40,000, the organization need to effect sales to the extent of 2 lakhs so that the desired amount of profit can be attained by the organization without any doubt. So now come to the break-even analysis of the cost volume profit analysis. Cost volume profit analysis, the most important of these factors are the cost of manufacture, volume of sales, and the selling price of the product. Cost, volume, and profit. Cost is the cost of manufacturing or manufacturing cost of the product. Volume means the volume of sales in respect of that particular product. And the selling price means the unit selling price of the organization, from basing on which we need to determine the contribution and other things. So what is break-even analysis? Break-even analysis means, in a narrower sense, it is the technique of determining that level of operation where total revenue is equal to total expenses. That means it is the point where there is no profit, no loss. No profit, no loss means the total of revenue, that means the total of income is equal to the total of cost. Total cost means it may be variable cost and fixed cost, and total revenue means the sale proceeds of the product for which we are determining we are calculating the break-even analysis. Secondly, in broad sense, it refers to the study of relationship between cost, volume, and profit at different levels of sales or production. There are two senses of break-even analysis. Break-even analysis is otherwise called the marginal costing. Break-even point means the point at which there is no profit or no loss. So in a narrower sense, the analysis of break-even is confined to determination of the point where the total revenue is equal to the total cost and there is no profit or no loss at this juncture. This is the narrower sense of break-even analysis. But the broader application of the break-even analysis is, it refers to the study of the relationship between cost, volume, and profit at different levels of production so that we can be in a comfortable position for taking several managerial decisions which are needed for the stability of the organization and for the sustenance of the organization. So there are certain assumptions of the break-even analysis, about 7 assumptions of break-even analysis. The first assumption in respect of break-even analysis is all elements of cost, production or factory cost or administrative and selling and distribution costs are segregated into two segments, that is variable cost and fixed cost. Second, the fixed cost remains constant at all volume of output. It will never undergo a change. It will remain constant for the entire volume of output. Third, variable costs remain constant per unit of output irrespective of the level of output and thus fluctuates directly in proportion to changes in the volume of output. Variable cost, since the very characteristics of variable cost, it varies directly and proportionately with the volume of production. So that is also an assumption. The third assumption under the break-even analysis, that is variable costs remain constant per unit of output irrespective of the level of output and thus it fluctuates directly in proportion to the changes in the volume of output. The fourth assumption is the selling price per unit remains unchanged or constant at all levels of activity will never undergo a change, either increase or decrease. It will remain constant throughout. The fifth assumption of break-even analysis is the volume of production or output is the only factor which influences the cost. I'm reiterating, the volume of production or output is the only factor which influences the cost. That means the total, when we determine the total cost of the product, the contribution would be the sales minus variable cost. When the sales remain constant and the variable cost remain constant, the contribution per unit will remain constant. But when the volume of production increases, then per unit fixed cost will go down and down, and that will definitely influence the total cost of the product. When the number of units produced increases, then the per unit fixed cost will obviously be decreased. And since the fixed cost per unit fixed cost is a part of the total cost of the unit, obviously it will definitely influence the cost of the production. The sixth assumption is there will be no change in the general price level. That means it will remain constant throughout. The seventh and the last assumption in respect of break-even analysis is there is only one product, or in case of multi-product, the sales mix remains unchanged, unaltered. If there is one product, it's fine. If there is multi-products, then the sales mix, that means what is the mix of product 1 and product 2 or product 3, that should remain unaltered and remain unchanged throughout. Otherwise, the break-even analysis will not work out properly. The next step is break-even point. The break-even point, it may be defined as the break-even point, or BP. It may be defined as the point of sales the point of sales at which total revenue is equal to total cost. The total revenue must be equal to total cost, as a result of which there won't be any element of profit or loss in the hands of the organization. The revenue would be equal to the cost. At this point, contribution, that is sales minus marginal cost, equals the fixed cost, and hence this point is often called as a critical point or equilibrium point or balancing point. Balancing means a balance is being maintained between two aspects. One is the revenue, another is the cost. Revenue is equal to the cost. And it maintains the equilibrium between these two aspects, revenue and the cost. And it is the critical point because if the production goes below the BP level, then obviously there will be loss in the hands of the organization, and no one can save the loss from the organization if the production is lower than BP. That's why it is a critical point. At least for the existence or for the very sustenance of the organization should attain the break-even. Even if it is not earning any profit, but it will just be in a position to recover all its expenses or costs at the level of BP. So BP can be computed through two methods, that is algebraic method and the graphic method. There can be a graphical presentation of the BP, break-even point, or there is another algebraic method of presentation. The formula for calculation of BP, that means units of sales volume, is equal to fixed cost divided by contribution per unit. Fixed cost contribution is represented through an equation, that is sales minus variable costs. So fixed cost divided by contribution per unit, which is determined by selling price per unit, and the difference between selling price per unit and variable cost per unit, that would be the break-even point. So formula of BP, that means budget total, or in terms of money value, that is total sales is equal to total fixed cost plus total variable cost, that is the total cost. Sales would be equal to the total cost, that is called the BP. Sales is equal to fixed cost plus variable cost, or sales minus variable cost is equal to fixed cost. These are the different equations of the break-even point. Break-even sales is equal to fixed cost divided by contribution into sales. In other words, you can say that the fixed cost divided by fixed cost plus profit multiplied with sales, that would also be the break-even sales. In other words, fixed cost divided by PV ratio. PV ratio is given in form of a percentage, profit volume ratio. So as profit volume ratio is contribution to sales ratio, then the break-even sales can also be determined by dividing fixed cost by the profit volume ratio. So these are the different equations of break-even point. Again, formula for break-even point as percentage of estimated capacity. Break-even as percentage of capacity would be fixed cost divided by total contribution. Take an example for the discussion of the issue. Output is 3000 unit. For a particular product, the output is 3000 unit. Selling price per unit is 30. Variable cost per unit is 20. And the total fixed cost is 20,000, which will remain constant over a period. In this juncture, the BP in unit, that means by selling how many units we would be at BP, no profit, no loss. Here, the fixed cost divided by selling price per unit minus selling price per unit and variable cost per, the difference is what? The contribution. When the fixed cost is divided by contribution per unit, we are having variable cost per unit, we are having the sales price per unit. Sales price per unit is 30, the variable cost per unit is 20. 30 minus 20, the contribution per unit comes to 10 rupees. When the total fixed cost, that is 20,000 rupees, is divided by the unit contribution per unit, that is 10, 20,000 divided by 10, that gives rise to 2,000 units. So when the organization is producing exactly 2,000 units, then it will be at break-even. It will be at break-even means its total of revenue would be exactly equal to the total of sales. You can check. When 2,000 units are produced, the contribution per unit would be, or the variable cost per unit would be 30,000 per unit. It is 30,000 into 2,000. Sorry, rupees 30 per unit into 2,000. It would be exactly similar with that of the revenue. Revenue is, when 2,000 units are produced, the selling price per unit is 30 rupees. So 30, the selling price would be 30 into 2,000, that would be the total revenue. And the variable cost would be, the total cost would be, variable cost would be 20 into 2,000, and the fixed cost would be 20,000. When that is added to, it would be exactly similar to that of the 60,000. BP in sales, that is explained in a later stage. Fixed cost into sales divided by sales minus variable cost. Sales is equal to 3,000 multiplied with 30. That means it is 90,000. Variable cost is equal to 3,000 into 20. It is 60,000. Hence, BP is equal to 20,000 into 90,000 divided by 90,000 minus 60,000. That is also coming 60,000. Otherwise, as the BP is 2,000 units, break-even sale would be 60,000 units, because the unit selling price is 30 rupees. 2,000 units into 30 rupees as the unit selling price. So 60,000 is the revenue and 60,000 is the cost. So exactly the break-even point is achieved when the units produced or the volume of sales is 2,000 units. Come to a second example. The fixed factory overhead cost is 60,000 and the fixed selling overheads is 12,000. Variable manufacturing cost per unit is rupees 12. Variable selling cost per unit is rupees 3. Selling price per unit is 24. So break-even point in terms of sales value and in units. When you go to calculate this, the first break-even point is equal to fixed cost divided by selling price per unit minus variable cost per unit, which is otherwise called the contribution per unit. Here the fixed cost is given. We can calculate it 60,000 plus 12,000. 60,000 plus 12,000 means the 12,000 is the fixed cost and 60,000 is the fixed factory overhead. Fixed factory overhead plus fixed selling overhead, both are coming to 60 plus 12, that is 72,000. So the total fixed cost is 72,000 and the contribution per unit is equal to sales per unit minus variable cost per unit, that is 24 minus 15, that is coming to 9. So when 72,000 is divided by 9, it gives rise to the resultant figure, that is 8,000 units. That means at 8,000 units, the organization will be at break even, and at that particular point, there won't be any profit, there won't be any loss. If you want to cross check this, the variable cost for 8,000 units would be, the variable cost per unit is 15. There are two variable costs, one is 12, another is 3. So the total variable cost per unit is 15. And when the unit produced is 8,000, so 8,000 into 15, the variable cost would be 1,20,000. And the total fixed cost is, there are two types of fixed cost, factory overhead 60,000, selling overhead 12,000, total is 72,000. So the total cost is total variable cost plus fixed cost, it comes to 1,92,000. And the total revenue would be, when the unit is 8,000 and the selling price is 24, so 8,000 into 24, it is 1,92,000. So the total of revenue is exactly matching with that of the total cost. Total cost means both the components of cost, fixed cost plus variable cost. So the equation holds good. So the second item to be determined, the second result to be determined from this is the number of units must be sold to earn a profit of 90,000. That means the desired amount of profit to be earned by the organization for a particular period, if it comes to be 90,000, then what should be the volume of sales effected by the organization with the prevailing situation? Here, the total amount of the desired amount of profit has to be simply added with the fixed cost, and the whole has to be divided by the contribution per unit. That would be the volume of output at which we can attain the desired amount of profit. Here, 72,000 is the fixed cost, which is the combination of the factory overhead plus fixed selling overhead, fixed selling overhead 72,000, and the desired amount of profit as given in the question is 90,000. So the total comes to 70,000 plus 72,000 plus 90,000, it is coming 1,62,000. When 1,63,000 divided by the contribution per unit is 9, because sales minus variable cost. Sales is 24 per unit, 24 rupees per unit, and the variable cost is 15 per unit. So 24 minus 15, it is 9. So when 1,62,000 is divided by 9, it gives rise to 18,000 as the volume of output. When the unit produced are 18,000, so at that point of time, the organization can earn an exact amount of profit of 90,000, which is the desired amount of profit. That means your sales or your revenue would be exactly in excess of 90,000 than that of your total cost. You can check out. For 18,000 units, the variable cost would be 18,000 into 15. It is coming 2,70,000. And the fixed cost is 72,000 in respect of factory overhead and selling overhead. And so both the total cost would be 2,70,000 plus 72,000, it would be 3,42,000. And the profit is 90,000. Cost is 3,42,000 total cost plus desired amount of profit is 90,000. So the total selling price would have been 4,32,000 for the 18,000 units. So 4,32,000 should have been the revenue. Let us see, by selling 18,000 units, what is the revenue in our hand? The selling price per unit is 24 and the units to be sold is 18,000. When 18,000 is multiplied with 24, the exact amount comes to be 4,32,000, which is the combination of the total cost plus the desired amount of profit of 90,000. So this calculation helps us a lot for determination of the break-even point and the desired amount of profit and the volume of sale with the desired amount of profit to be undertaken by the organization. Let us come to the third example. The PV ratio. From the following, you can calculate the PV ratio, the break-even sales with the help of PV ratio, and the sales required to earn a profit of rupees 4,50,000. In this case, you see, the selling price per unit is given as 12. The variable cost per unit, there are three components involved in it. One is the direct material, which is 5 per unit, rupees 5 per unit. Direct labor, which is rupees 2 per unit. And direct overhead, which is also rupees 2 per unit. So the total variable cost per unit is coming to rupees 9. When the selling price per unit is 12 and the variable cost per unit is 9, obviously the contribution would be sales minus variable cost. That means 12 minus 9, that would be 3. So PV ratio would be, contribution to sales ratio would be contribution divided by sales into 100. Contribution is 3 and selling price is 12. So 3 minus 12 into 100, that is 25%. So the PV ratio is 25%. And the break-even sales would be the fixed expenses divided by PV ratio. Fixed expenses is 90,000 here. So 90,000 divided by PV ratio, 25%, that is 3,60,000. So 3,60,000 is the break-even sales. That means the sale proceeds to be realized when there won't be any profit, there won't be any loss. And the sales required to earn a profit of rupees 4,50,000. If the desired amount of 4,50,000 in our hand, then what should be the volume of sales or the amount of sale proceeds? What is the sales? The total sale proceeds in our hand to earn a desired amount of profit of rupees 4,50,000. In that case, the desired amount of profit has to be simply added with the fixed expenses and whole has to be divided by PV ratio, and the difference would be the sales required to earn the desired amount of profit. Here it is 90,000 is the break-even, 90,000 is the fixed expenses, and the desired amount of profit is 4,50,000. Both comes to 5,40,000. When 5,40,000 is divided by PV ratio is already calculated to be 25%. It comes to 21,60,000. So 21,60,000 is the desired amount of sales to be effected for earning a profit of 4,50,000 in our hand. It can be cross-checked. The calculation can also be cross-checked by us. So 1,80,000 would be the unit. 18,000 would be the unit. 18,000 unit, the variable cost for 18,000 unit would be 16 lakhs. Sorry, 1,80,000 would be the unit. And for 1,80,000 units, is the variable cost is 9 per unit. Then the total variable cost would be 16,20,000. And the fixed cost is 90,000 as given in the question. So the total cost comes to be 17,16,000. And when that is 17,10,000, when that is added with the desired amount of profit, that is 4,50,000, then 4,50,000 plus 17,10,000, it is coming to be 21,60,000. And if we will determine this 21,60,000, that would be the exact selling price of 1,80,000 units. 1,80,000 units at rupees 12. Rupees 12 is the selling price as given in the desired example. So when 1,80,000 is multiplied with 12, that gives the exact revenue of 21,60,000, which is similar with that of the total cost of 17 lakhs 10,000 plus the desired amount of profit of rupees 4 lakhs 50,000. So thereby the total of revenue is equal to the total of cost plus the desired amount of profit rupees 4 lakhs 50,000. So accordingly we can satisfy or we can cater the need of earning a desired amount of profit in our hand. Thanks. Thanks to all.